Choosing any investment can be a difficult and potentially overwhelming process. Many investors are simply mystified by the technical details or bullied by pushy salesmen and may end up making potentially bad decisions. It's ironic how so many people rely on and invest based on a simple presentation of past performance. Even though it is written on almost every page, past performance is no guarantee of future results. Past performance is a factor, but it is only one of the factors we look at. My name is Mike Ellis, and I'm the Chief Investment Officer of Pioneer Wealth Management. I have 20 years of experience in helping wealthy families manage their wealth, and in this short video, I hope to give you a few tips to think about when choosing a hedge fund. Hedge fund is a very broad term. It's a bit like saying car, because there are so many different types. In addition, people make the assumption that a hedge fund will always hedge your portfolio. This is not particularly true. Unlike normal mutual funds, which financial regulators have tried to standardize, the hedge fund world has tried to remain free of the regulators' limitations as much as possible. There are some regulated hedge funds, but there are many more which are not. So you may consider that regulation is already one of the criteria to consider when choosing a hedge fund. Just like when choosing any investment, one needs to define the objectives. Normally, investors will say they are simply looking for good returns. But that is a huge oversimplification, because we need some sense of the risks being taken with our money. Outperforming hedge funds are very difficult to identify in advance, and too often they are disappointing in both absolute and relative comparisons. So why invest in a hedge fund? Basically because they offer different risk-return profiles compared to traditional investments. So if you're going to invest in hedge funds, please consider some of the following issues. Firstly, if you don't understand the strategy, don't buy it. Asking questions after something goes wrong is unfortunately too late. Second, the number one rule of asset management is never put too many eggs in one basket. So for example, never put more than, say, 5% of your liquid wealth in any one fund, no matter how good the story is. This is common sense risk management. Third, hedge fund fees are usually very high and sometimes include several layers. I've heard investors say they don't care what the charges are as long as they get their returns. I strongly disagree with this approach because it is the investors, not the manager, who need to be rewarded for the risk that is being taken with their money. The fourth point to consider is that size matters. Look for funds with a few $100 million under management and a broad investment team that provides organizational depth. Another thing to check is, does the fund do what it says on the box? Longer track records do give comfort. Lastly, check the facts. You won't believe how often back-tested and not real information gets presented on fact sheets. This includes checking investor communications, particularly in the losing months. To conclude, we are not only trying to pick the best performers, but we're also looking for the most predictable funds. Applying professional level tools and methods to the selection might sound too intimidating, but it is the only way to increase the chances of choosing the right fund. If you have any questions, please feel free to contact us.